Thank you all for sticking around for what I hope promises to be a very spirited conversation. So the guys and I were sitting in the speaker's room a little bit earlier and having some really good laughs and some collegial disagreements. And I know it's been a bit awkward during the conference that there's not been a lot of Q&A, and I think that's too bad. I mean, because we're here to answer your questions and to also get your insights, so please don't be shy. Anyway, I'll introduce myself. I'm Margaret O'Connor. I'm the chair of Launch Africa Venture Fund, which is a new VC on the block. We are the single most active early stage tech investor in Africa, having made 67 investments in 14 countries in 15 months since we were created. And we're going through a bit of self-reflection about, are we in the future going to be Tiger Global or Sequoia? So, TBD, but very reflective
be
team.
Be Sequoia.
But we're all about bringing more smart money onto the continent. And Launch Africa actually has 125 LPs from around the world, a lot of private equity partners investing in their personal capacity, tech entrepreneurs who are mentoring their African peers, corporate execs from Africa taking a front seat at the table, looking at these early stage tech opportunities with the view to more meaningful participation in many venture funds in the future, whether it's corporate venture or other funds. Anyway, we have a great panel. Ido, if you would start off. So I've asked the guys just to tell them to share with you some of their most burning investment mandates. We're looking at VC to 2030. A lot of the conversation at the previous panels was kind of looking at COVID and the move of private equity into VC. And I've really asked everyone to think, how do they think VC is going to look in 2030, and what are we going to do between now and then? And Ido, I also asked each of the panelists to share something secret and personal that maybe has shaped who they are, what they do, and how they spend their time, the kind of stuff that you would expect to hear at a cocktail party.
Sure. Hi, everyone. I'm Ido. I'm a partner at TLcom. I've been with the fund for the past 10 years, and we've been one of the very first VCs in town. Just closing our second fund now, and outside of when I'm not doing VC, we have taken a decision in the summer to homeschool our younger son, so that's my other day job as a part-time teacher, which my wife is the head and I am the deputy, and that's something that is not venture related.
No, but that might inform some future edtech investments or something else.
Oh, yes.
Cool.
Hi, I'm Tobi, managing partner of V8 Capital Partners. We invest across the continent. We're a specialized firm. We do enterprise technology investments, which primarily means we're similar to Vista Equity. We're focused on a B2B2C model, ensuring that our technology businesses can become platforms. We do, I don't have a fund, but we do have LPs, about 30 to 40 LPs who've invested on a deal-by-deal basis. We're trying to set up our new maiden fund Q1, Q2 next year. And fun thing about me, to be honest, I didn't give it that much thought, but my first job, which I failed at, was picking up litter at Community Shield, A-levels, Community Shield football match. And I thought it was so easy. I thought it would be so easy, and it was a big check to me at the time. And it was overnight. And after one or 2 hours, I was unable to continue, and I didn't get paid. So that was a fun thing, and maybe it's helped me.
That does sound like a part of the VC job at moments.
Yeah, learning grit.
And learning to be humble.
Yeah.
I think that was another important thread there. And doing the job that's required, right? Rolling up your sleeves to do whatever's required at the time. Thank you so much. Eghosa?
Hi. So my name is Eghosa. I am the founder and managing GP of a firm called EchoVC. We are 10 years old, and have been investing in Africa for, I think, roughly the last 7 years. We do seed and early stage tech VC, Pan-Africa focused, and pretty much open to every sector except solar, because I don't believe solar is a VC-able sector, but that's what it is. And fun thing about me, so very interesting random conversation recently. I reconnected with an old friend. I knew him when he started a company back when I was at Intel Capital, and we were on a call with this other company, and we're just chatting, and so the founder of this company was like, "Oh, where did you get your comp sci degree from?" And I said, "Comp sci degree." And he was like, "Oh, Barney was like so excited. He was like, oh my gosh, like, and I was like, comp sci degree, I have a law degree. I've never done anything near comp sci." And he was like, "Well, how are you managing semantic technologies at Intel?" I said, "I just read stuff." That's what I did. So Barney that I've known for almost 15 years, just learned in that call that I did not have an engineering degree or a comp sci degree. And so, fake it till you make it apparently works.
Well, and training as a lawyer and knowing how to read and sift through things
Yes.
and build on what you're reading is amazing.
Yes.
And I didn't share my fun fact. My fun fact is I survived a pirate intervention when I was sailing a yacht. I was a skipper on a yacht for the head of Volvo Asia, and we did a 6-month journey around the Indian Ocean up to the Red Sea. And I was doing night delivery into Male, and pirates jumped on the ship and with the guns blazing. And I sailed us to safety. But when I was reading my kids' bedtime stories about pirates, I'm like, yeah, Mommy survived the pirates. I was able to talk them down. I didn't have to fight them off.
That's great. Best story.
Anyway, I thought we'd start the conversation talking about, is the African discount disappearing? We had a little bit of a look at, African assets, early stage tech, beyond Series A. Is that a thing of the past?
I think valuations are definitely going dramatically up, and some are going to US to look for funds. I would say that in my perspective, in our perspective, we're seeing in some very specific sectors more alignment to what we're seeing in global markets, but in majority of sectors there still is some form of a discount, which is one of two: either global capital doesn't understand the opportunity or doesn't see the opportunity, or otherwise there is still a reluctancy on how exitable some of these are, because there are models being built in Africa and India and some other emerging markets that no one has exited before, which is not to say they cannot be exited, but it's very hard to look at something that looks the same and happened already.
I think that's a really important point. Anyone else want to expand on that?
I mean, my view on the valuations is anywhere value is being created, there's a rush of money, and the rush of money means that valuations will go up. And that's what we're seeing in tech at the moment. But an important distinction is that tech doesn't build on capex like the third industrial revolution. It builds on intellectual property. And intellectual property doesn't have a geographic mix. So international investors don't have a given African tech businesses similar valuations as they give US businesses. But that's predicated on the assumption that they can use that IP in a global fashion. It may not always work, so some people are making mistakes, other people are bang on it. But it's an important distinction for me to see that it's really about IP, and there's no reason why African IP would be worse off than global IP. Just to give you an example, we invested in a biotech company, and it's a genome company. But the African genome is actually the richest genome in the planet, because everyone came from Africa. So, but the most valuable genome company is Irish, because most Americans came from Ireland. But if you track everyone back. I think it's Ethiopia or Botswana or somewhere in Africa that everyone came from. And so why would you give it a discount? Because the database is richer than any other database that you have, yeah.
So I'm guessing that's 54MB.
Yes, it was 54G. Yeah.
Sorry, 54G.
Yeah.
So I was, as you know, in New York recently, and Esther Dyson walks into the room, you know, and I'm trying to educate U.S. family offices about the opportunities in African tech with her T-shirt and telling stories about how this is one of the best tech companies she's seen in the last few years. So I'm like, thank you, Esther. You really sold African tech for me. It was much easier after she did that. But Eghosa, if you could maybe expand on the African IP going global, and you know, if again back to the frame of VC between now and 2030, what do you think needs to happen on the continent to ensure investors and operators are on the same page about IP protection across the continent and valuation for IP created in Africa?
So I think, so the traditional construct for how you think about valuations, at least in the public markets, is that today's valuation is just the net present value of future cash flows. But you know, we're in VC where the concept of a cash flow may or may not actually be present, right? And so it is really the net present value of future ambition. And so when people think about sort of the Africa discount and the like, it is because, you know, in other markets, we've seen the kind of value that can be created by unbounded ambition. We haven't seen that in Africa quite yet, right? So, I mean, you see it in some of the larger sort of traditional businesses, right? That's why Africans are on the billionaires list and whatever it is. But, you know, whether it's, you know, it's commodities or it's diamonds or whatever it is. But, you know, technology still hasn't sort of, you know, broken that sort of threshold where you're thinking, wow, okay, I can see what unbounded ambition can do here. And I think for us, you know, the thing about African VCs that maybe would distinguish us from the US VCs is that I think we're a little bit more pragmatic because we understand the coefficient of drag in a much more nuanced and a deeper way than, say, the US guys, right? So someone comes in, they're like, oh, this looks like X and Y, and I did it in India, and I did it in Southeast Asia, it must work here. You know, meanwhile, the local VCs are like, no, let me explain why it doesn't quite work like that, and you can throw as much money into this problem as you want, but that's not what's going to shape it. And so I think that's the Africa discount, is really a complex relationship with coefficients of drag. And once you're able to sort of work out what those coefficients of drag look like, and you sort of start to improve the aerodynamics of these opportunities, then you can sort of see how things can really go. And I think even in our conversation, I talked a little bit about one of the things I love about investing in Africa is that we've always looked at technology in a very sort of asymmetric way, right? And so look at these companies and you're thinking, oh, the technology only must come from outside in, right? But, you know, you're also seeing more and more companies that are not necessarily first order geniuses on you know, advanced disruptive technologies, but the advancement is in business models, right? And the ability to apply technology into problems that people don't see, aka sort of what we call open secrets. So, you know, we're very bullish about these companies honing themselves in Africa and attacking emerging markets. You know, I mean, I don't know how many of you have sort of been into the middle of the US, but if you ever go to places like Alabama or Mississippi, you're looking at emerging markets. I don't care what anybody tells you. And so, you know, we get very excited because I was like, look, some of these African companies, when they crack the code, and they can do it with such high coefficient of drag that when you now go into markets that don't have that drag, but still have people that are completely unserved or underserved, oh, it's game over.
And
So what's exciting.
I'm just going to build or share an example when you talk about parts of America being emerging markets. So Launch Africa just invested in a fintech that's domiciled in the U.S. where they built the proof of concept in like Alabama with a bunch of developers in Cape Town with the intention that they were going to build the valuation and some users in underserved markets in the U.S. and serve LATAM and Africa and, so point taken about emerging markets around the world.
I mean, in machine learning, there's a concept called the people like me clusters, right? Where you're essentially recognizing that there are clusters where you can see lots of similar things. And when you think about the world in people like me clusters, you will find out that the way some of these emerging markets, wherever they're in the US or in the UK or in Africa, there's very similar things. So one of our companies is out raising now, and they're an emerging markets play. And so, they went into, they're raising sort of a larger round, so they went to talk to some strategics in the US, and, completely weird outcome. Because they're talking about, look, this is what we're doing in emerging markets outside the US. And they're like, no, you don't understand. You have solved our problem here. Like, we've never been able to solve this problem here, and we just realized that you solved it. And they're like, we're not interested in the US market. And they're like, no, you need to be interested in the US market. So it is interesting validation that you can build this IP, and it can be worth even more because no one in these large markets has cracked the code.
Want to build on that?
No, I think the difference, and we've discussed a little bit earlier, is that in a lot of the more developed markets, your assumptions when building are that certain sectors are structured in a certain way, and the certain way is usually very high consolidation, so you're relying on an existing consolidated infrastructure. Whereas if you go to the emerging market, regardless of where it is, this is usually extremely fragmented. So you cannot rely on these, whether it be in retail or in logistics or in whatever, you cannot rely on these structured verticals or rails to support you, and you plan your whole business differently. Now, when we look at the way that retail consolidated, supermarkets consolidated in the West 70, 80 years ago, or the way that a lot of the other sectors consolidated over the past few decades, it was done with a technology and thinking that was at hand at that period. But we have different technologies and different skills nowadays. So when we're looking to consolidate, again, what was done in the US in the 50s, but with today's technology, maybe we would design the system bottom up very different. I think then you can go with this to those pockets in the US or in China or in wherever, where they're still unstructured, but no one is thinking in such a way because their thinking is blocked by structure, and you can become very, very interesting in these markets as well.
So something to note is I go back to this third industrial revolution and fourth industrial revolution. In the third industrial revolution, you solve problems by capex. You have a capex, you need a big enough market, it serves that market, and it's game over. You don't put capex in markets that are too small, or even in developed markets in pockets that are too small. But technology is primarily talent, or shall I say IQ, or intellectual property. And an intellectual property can choose to attack any problem. And because the cost of attacking the problem is so low, you now have the opportunity to aggregate all those pockets that the third industrial revolution with big capex wasn't going to address. And you can create something of value that in the old business models might never have existed. And it might be so valuable to Eghosa and Ido's point that it could even take on the traditional, because it was built with so much drag, so many issues, so many changes, etc. So that's another advantage, is that you don't need, I reckon you need maybe $20 to $50 million to fully build out a product that can scale globally. But before, you would have needed like hundreds of millions in the old, non-digital distribution type businesses. So that's for me is an important distinction.
But when you're talking about that type of investment, $20 to $50 million, and a theme of this conference is private equity coming into the VC space, and us looking at VC in 2030, why don't we talk a little bit about traditional VCs, what can we teach private equity as they come in and they want to play with us in earlier stage companies? We'll start there.
So, I've been coming to this conference for years, and it was interesting. In the last 6 months, I've talked to LPs here that didn't even make eye contact with me at this conference years ago. And, but I don't sweat it. It's all good. We play the long game. I'm like, you'll eventually figure it out. And, but what's interesting is that the private equity lens, it needs to be completely reformatted, right? Because these are not transferable skills. They're just not. And people assume, well, I did private equity. I was making the joke about private equity was, you wake up in the morning, you wear your Brioni suit, you show up, you give a bunch of instructions, you leave to your private jet, and you're out, right? And, you fundraise through people, through intermediaries, right? You show up for the final meeting because the big pension fund just wants to be able to shake your hand, but you're not actually sort of engaged in the day-to-day. That's private equity, right? Versus VC, that you wake up in the morning, you wear your gym pants, your t-shirt, your flip-flops, and you're like, let's go wrestle, right? And it is one firefight after another, and you have to want to engage in this as a contact sport. This is just what it is. But the karmic value and the sort of the rewards, both financial and otherwise, are just on a scale that you can't get in private equity. But a lot of private equity, the real question you have to ask right now is, why is African private equity chasing VC today, right? And it's hard to not conclude that it's a search for yield, because they've not been able to make a lot of money, right? In what, 5 years ago when, people considered me as a VC disruptive, I would come in these panels and I would be like, African private equity, the way it's currently constituted, doesn't work. And, like, oh my gosh, you're making fun of these people. I was like, no, seriously, I'm just like, it doesn't work. PE light works in this market, not PE. All right, and so these funds are too big. They don't work. It takes forever to do that. And then the yields, and then you're trying to think of headwinds and currency depreciation, and devaluation and all that good stuff, trouble. So VC is sort of the hot bell of the ball. It does provide yield. But why it doesn't transfer is that a private equity firm could have a very concentrated portfolio, right? And you're also really promising 2x. Yeah, for your mind to move to I'm going to make 10 investments, I'm going to lose money in 9, and that 10th one is going to be the outlier, is a massive shift in just religiosity, right? And so I don't know how that's going to play. I am sort of the view that, if you bring the ego that you sort of works well in PE into VC, it's not going to translate well. But what I would say, though, is that we need a lot more money in Africa VC than currently exists. So if there's more money coming in, whether it's via PE or DFIs or institutionals or family offices, I'm just happy, right? But I am a little concerned that it isn't just the money anymore, but it is the stewardship of the money that's also going to be as important.
That's a really good point. Tobi, could you talk a bit about kind of bringing African family offices into VC investing and how important that is for the success and scalability of what we're doing?
Okay. So I invest, till date. I've invested, all my deals have been deal by deal, and I have about roughly 50 30 African and 20 non-African family offices, some small corporates, etc. So I deal with HNIs, and I feel that to crack African business problems, you're going to need strong families and strong business people, because as Eghosa and Ido have mentioned, the headwinds are so strong, and you need to be agile and you need to be smart on how you solve them. And most of those solutions lie with maybe 1,000 families across the continent that can give you access and solutions everywhere. So I'm of the opinion that you need to have a vehicle that carries them along. And in talking to these entrepreneurs or business people, a lot of them have made money in Africa through blood, sweat, and tears. And unfortunately or fortunately, it's not really about tech. They just don't want to lose their money. So they would put the money in real estate, in anything that they can see, feel, touch, and see, or they will put it in bonds and just be able to check that the money is still there. And it's important to educate the same way Eghosa was talking about, because I've been coming to SuperReturn for over 10 years, and technology was never a thing. It was all about the emerging consumer, infrastructure, and those buckets. But people need to realize that disruption is happening no matter what we feel, or no matter what we want to do or not want to do. It's happening. Things that, we currently don't bank. No one goes to get a mortgage or a loan by walking into a bank, sitting down with your bank manager. It doesn't happen anymore. You do it on your phone, or you do it on your PC. And that's going to happen in every single industry, and at different paces and at different times. So this is the message I tell the HNIs and the African LPs, that you need to jump on board, because first of all, we don't even have the infrastructure of the developed markets. And second of all, the underserved infrastructure is going to get disrupted. So, where do you want to be? Do you want to be in is it 500,000 phone lines we had in Nigeria versus 200 million mobile phones, right? It's night and day. So, and the message is getting across, because initially I used to call people to tell them, is this a great deal? And now I'm getting calls saying, hey, show us deals, we want to do deals, etc.
If I could just ask a follow-up, with the HNIs, do you find them most willing to invest in businesses that are disrupting their incumbent businesses, or are they experimenting outside of their comfort zone?
I think it's usually outside. When it comes to them, usually there's usually some denial that this is not going to happen.
Yes.
It's not going to happen until it does.
Right.
It's interesting that Tobi mentioned something, because it just reminded me 3 years ago, 2021, 3 years ago, I remember going to Helios and to ACA. And I was like, I think you should carve out some money for VC. Oh no, just straight up dismissed. Like, no, that's not what we do, right? And it was interesting because, Cyril at ACA, may he so rest in peace, he was one of the older, what was interesting was he was one of the older folks at ACA, but he was probably the most receptive to this idea, right? He was like, no, I think you have something here. This thing is right. Like, this thing is right. But, he couldn't do it on his own. So I think what's interesting is that even the folks who have sort of been around the block and the like understand what Tobi's saying. They may not necessarily characterize it in that way, but they understand that there's a shift happening, right? And the drivers of that shift are younger folks and things that, they've not historically been able to control. Right, and it reminds me of a conversation I had with one of, a CEO of a bank in Nigeria, where he's telling me that the only way you make money is you need to just control all the licenses. Like, that's the game. The game is just control the license. Find the license and control that. And I'm thinking, technology that's not in the technology bibliography. Like, it's not, like, you can sit down and talk about these licenses all day long. Because I'm like, I look around now, I look at all the crypto activity, and I'm like, where's the licenses?
Yeah.
Mm-hmm.
I'm like, that model will not have worked. Mm-hmm. So you are right in the sense that if you had pitched some of these things to him, he would not have understood it, because he's like, well, the lever is the license. I'm like, there is no license here, right? So it is fascinating to watch that shift and watch how some people are definitely spearheading it and some are being dragged into it. But I think the curiosity is there.
Yeah.
Right. So that's important.
I want to take a different angle on ego. You talked about ego and private equity. Ido, if you could talk about maybe ego in the boardroom and how to manage that to support the growth of VC going forward.
I think, to tie it maybe to a little bit to the private equity conversation and the difference in how these might or might not merge is we as managers, we're not business owners. We don't own the businesses in which we invest. We're minority shareholders, and that is a huge mental difference for several reasons. One is you cannot come in the morning and say, I think that this is how we do it, and then it happens, because they can just say, and we think we don't, and it doesn't happen. And yes, you have your veto rights and whatever, but the big difference is that then your only true reliance at the end of the day is on trust. You cannot replace management. It's really the last of resorts is replacing management, especially the earlier stages. Later we can speak about that. You need maybe different management teams for different stages, but for the first few years of the journey, you need the founding team, the ambition, the vision, and then you're really reliant on this trust and ability to make the founder, the leadership team believe that what you want and what they want is the same thing. And that sounds very simple, but is very hard at times. And we're talking about many times younger people that have not managed, these companies can go from 0 to 250 or 500 employees in the course of 3 years with retention issues and with, now they're not. It's not that they had 8 guys in the room or ladies in the room and they said something and it happened. Now it's, people in 3 countries or 7 countries and 16 offices, and you need structure, and this requires a lot of changes, and you as a board member have seen it happening in 10 other companies 7 times before, but you can't convey the message by just implying this is the right thing to do. You need to convince them, to make them believe it's the right thing to do, and I think it's a very big difference. There is now a little bit of an unfortunate, or fortunate, depends who you ask, I guess, phenomena of, because of very, very large funds, especially international funds coming in, this is fairly marginal for them. So because of the nature of their investments, they don't take board positions, which gives the founders the belief that they don't need a board and they would do much better without one. That became fairly prevalent in some of the US startups and is coming down to our region. And I think we're a bit struggling with that, because the fact is, A, the US ones are anyways surrounded by more experienced people just by the virtue of the market they're in than the African founders. But B, it also doesn't suit everyone. And I think it is not about being in conflict with your board. It's about how do I as a board member create this trust relationship over time. And it's not through reporting or through the quarterly meetings, that's through daily WhatsApps and dinners and drinks, to be able to drive or the founder to where I already saw things happening before, and I can help him get there in a better shape.
Well, and I think, Eghosa, if you can maybe expand on that idea of how do you manage and motivate founders, not only through your example, but by surrounding them with other resources to get them where they need to go to continue to create value in their company.
Yeah. So watching, this is actually a very real thing where founders are now becoming so incredibly entitled because of how much liquidity there is that they're just not even interested in governance. They have zero interest in it. Right. I mean, we're considered founder unfriendly because we demand quarterly reporting, and that's the market we're in now. So the other sort of looming problem is that because deals are happening so fast, no one is spending the time pre-transaction building the relationships. And one of the key elements in every relationship is you learn how to communicate. And you learn to read and sort of understand how others communicate. So you don't really get that sort of building process to happen, which then means that you've got this challenge where the founder doesn't have any specific anchors where he or she says, I trust what you're saying. Right, so, I think it was, Tobi was saying, like, look, sometimes you just have to present the data, right? And and hopefully they will believe that, right? But what I found is that you can build a relationship, and I will share something just because, kind of puts me, I think, in an interesting light. So we had an investment we made, and halfway through the deal process, the terms changed, and so I remember being told by members of my own family that the founder was going to hate me for life, and I just knew it because I found myself, I got cornered, and there was nothing I could do. It was not something I would have done. And, and so we're at a dinner thing a few weeks ago, and the founder is there and some friends. And the founder is talking about how, I'd never talked about it, and just how much I was disliked because of that process. And, we're at a stage now where there is no major or minor decision that I do not get called for in advance. And I earn that every day. And so, that's really what this thing is about. It is about them being able to trust you, being able to be vulnerable with you. Governance is not just a letter in ESG, right? There are all kinds of interesting influence points that work, but it has to get earned. And and so what we're getting is with the speed and the pace of what's happening, right? Just in fundraising and in execution and in hiring and company building, you as a board member or as an investor, you have to ask yourself, what is your role? Are you the oasis? Are you the buoy? Are you the therapist? Because in fact, across the sort of the finish line, you will be all of these things. But you have to ask yourself, at the end of the day, what is the outcome you're looking for here, right? Do you want this founder to get to a point where he or she can sort of trust you to say, look, I have this, I have that? I have founders that will literally be like, here's what I'm going to write to the team. Please edit it for me. Yeah. And I'm like, why are you saying it to me? Oh, because you write with feeling.
And you understand my business.
And so I'm like, okay, sure, no problem. I'll just edit it. And by the way, this can be at midnight. It doesn't matter. But they're even comfortable enough to be able to do that. So when we talk a little bit about sort of governance and, as we're getting sort of this pace, stuff is going to fall through the cracks. Sometimes the cracks are very large. But we, I think, as investors, and because we're investors that are invested in the market, not just in companies in the market, right? Ido mentioned something in our pre-panel discussion around a lot of these US VCs and European VCs. These are satellite deals. They're just satellite deals. Literally, you can impair the deals the day after you close, and they won't even remember, right? But for us, it's core to our thesis, right? We're not going anywhere, right? And so just that shapes sort of the way we engage and we take these things for we don't take anything for granted, especially because we're not raising money at the pace that our US compatriots are. I was doing something where they're raising funds every 2 years. I was like, what? The typical frontier manager is 42 months on the road to raise a fund. 42 months, that's literally it's 4 babies and a half or something. And so there's a full family you can make in 42 months, right? So there are these very interesting things, and I think for each of us on the panel here, time has shaped us, context has shaped us, we've gotten smarter, we're making adjustments, market is moving very fast, but I think we're going to be the drivers of high performance yield in the market going forward. We're going to be the drivers for job creation. We're going to be the drivers for economic enlargement. There's no question it's us. It's not PE anymore, and won't be.
So that was just a timer to say we're moving from the panel to the fireside chat.
Okay.
But just in summing up, I think trust is the bedrock on which VC has been built in Africa and is something that's paramount to creating future value and ecosystem impact. Do you want to ask a question?
Yeah, sure. So I'm interested in the concept of net present value of ambition. Sorry, say that again. Okay, sure. No, interested in the concept of net present value of ambition.
Future ambition.
Yeah, I last heard that phrase in 1999, I think it was. But but I guess the question there being, there's a feeling that the market might be a little bit frothy, and is there a bubble? When you're seeing companies valued at 1,000 times revenue or whatever, how do you get investors or LPs comfortable that that's a trade that can make sense in any universe?
Okay, I'd like to take that, because there is a bubble. It's obvious. But there also is value being created. And the way I look at it is, I wouldn't phrase it as future ambition. I would phrase it as, how do you value future market capture? And when you build, keep going back to the third industrial revolution, you have CapEx, you give yourself 18 months and then you start selling, and you're capped at the capacity of your manufacturing or your power plant. It can't go more than 1 gigawatt, or you can't produce more than 1,000 a year. But with tech, there are no limits. Everyone uses WhatsApp, and they didn't build 1 billion factories, right? So the only way you can capture value is by looking at your revenue growth. Valuation is not an accurate science. Even with PE, your growth rate or your risk rate, all those things have variables. But there are more variables in VC. And the variable is, would the market capture lead to a sustainable business? Because you could buy market capture, right? And that's where GPs are super important, to differentiate between a bubble or people who are just me too, and actual market, and actual products that are going to capture the market. And I'd like to tie that into what bothers us every day, is how do you grow your entrepreneur to become a real CEO? Because you start off with an idea, and you start off with being able to code, but you now need to distribute nationwide, continent-wide, and potentially globally. And you need governance, you need proper management, you need to be developed. And obviously, Eghosa was talking about earlier that Sequoia moves about 60% of their CEOs because they're no longer right to lead the business because the business has grown. It's probably, I think it will be a bigger issue in Africa in terms of being able to follow the business and see yourself as an investor as well. But I would say that there is a bubble, but all you need to do is look at how we don't have any high street, there are no longer any high street retailers. I mean, ASUS bought BHS, I think it was for 300 million, and they were like, cheers, we don't even need your shops, you can keep it. We just need your brands. And when I was coming out of university, ASUS was not something that anyone used. It was like a random low, and then I remember BHS was trying to buy Marks and Spencer. And that was the big deal. All the private equity guys, Morgan Stanley was on the left, Goldman Sachs was on the right, and they were fighting each other. And ASUS bought BHS. I mean, so, what I'm saying is brick and mortar is disappearing. And more of that is going to happen. But the winners is the $100 million question, which is why I feel that backing good tech GPs is a good idea.
I will add one more thing because it's a good point. So the other sort of claim to fame I have is that back when I was in Intel Capital, I brought Facebook in twice to invest, and the IC wouldn't approve the deals. But the first time, valuation was 10 billion. I was going to write 260 million. And I had 100% conviction, and people are like, what is it about this, why are you so sure? Because it wasn't that just like I wanted to write that check. I wanted to write the whole round, which was 500 million. And people were like, that's crazy. And I was like, look, there's something about special entrepreneurs. And we still say it even within our firm. There are three things we look for. One, as a founder, are you a with or without founder? In other words, are you going to do this thing you're going to do with or without us? The second thing is there a unique secret that you know that nobody else does? And the third, which I think is very key to what you're saying, is this market, does it have any edges? The addressable market, does it have edges? Because we're not interested in addressable markets that have edges, right? So, because then you're just out there to create and expand. So when we talk about when I use that phrase, NPV or future ambitions, right, it is that, I declared in the IC that Facebook was going to be 100 billion before 2014, and I was dead on. I had no vision that it was going to be 1 trillion within 7 years of that. None. Would never lie. But that outcome is possible today, right? You've got Amazon Web Services at $64 billion run rate, growing 40% year over year. Soon to be worth maybe $1.5 trillion of Amazon's $2 trillion. Right? So these outcomes are getting so much bigger that when we talk about these future ambitions, you can actually draw a straight line, that there is no bound to it. And we're still working through that in Africa and all that good stuff, but you can sort of see these markets. And, he talks about WhatsApp. Look at WhatsApp. I don't know whether they're 1 billion or 2 billion, but WhatsApp is going to be eventually a 5 billion person network. That's insane. But it tells you sort of what distribution can happen, how it can happen through digital. So that's just an example of it.